inflation-indexed bonds. Some governments, including the United States, issue inflation-linked bonds. In the U.S., these bonds are called TIPS, which stands for Treasury Inflation Protected Securities. There are around $850 billion of TIPS outstanding, out of a total of $11.3 trillion in marketable U.S. government securities, most of which are just regular nominal Treasury bonds. The payments promised in TIPS are real cash flows. That means that the payments will rise with inflation, and to some extent they may fall with deflation. This is in contrast with bonds that are not indexed to inflation, for which the promised payments are nominal. The way TIPS work is that whenever there is inflation, the face value and the coupon payments of the bond increase. For example, suppose you bought a 10-year bond with a 1.5% coupon rate, and that over the next 10 years we have inflation of 3% per year. Here we have the coupon payments if it were just a plain nominal bond. The payments would be constant at $15 per year. And now here are the additional payments if it were an inflation-linked bond. So now the coupons rise to as much as $20 in the final year. And what about the repayment of principal or face value? After 10 years, you'd get only $1,000 if it were a nominal bond, but you would get around $1,344 if it were a TIPS or inflation-linked bond. Another way to see this is to look at the same figures expressed in real dollars or in actual purchasing power. If you bought the nominal bond, you'd see your spending power eroded. But if you bought the TIPS bond, the purchasing power of these coupons would remain constant, and the repayment of principal would give you the same spending power as $1,000 today, as opposed to less than $750 of spending power if you had been investing in nominal bonds during this time. The higher inflation is, the greater the benefit ex post. For example, inflation was running at around 3% per year in 1972, but it was running at around 12% by 1974. Let's imagine we had a repeat of this experience today. Suppose that you own a 10-year nominal Treasury bond yielding 1.5% per year. Then, under this inflationary scenario, the purchasing power of your coupon payments would sharply decline, and the value of repaid principal would also be greatly eroded. But if you buy TIPS, your coupon payments will continue to support the same purchasing power. Remember, these are today's dollars, so they represent purchasing power. And your principal repayment would also have the same purchasing power as it does today. Now, because of the inflation protection, there is no chance that you're going to be able to buy a TIPS bond for the same price as a nominal bond that offers the same basic coupon. Inflation protection is valuable, as it is insurance against an event in financial markets that can erode your spending power. So the U.S. Treasury typically issues TIPS with much lower coupons than their nominal bonds and tries to sell these TIPS at par. Recall again the relationship. The nominal yield equals the real yield plus expected inflation plus the inflation risk premium. The TIPS bonds are quoted at the real yield. They are expected to deliver the real yield plus expected inflation. Another way to rearrange this equation is the real yield equals the nominal yield minus the sum of expected inflation and the inflation risk premium. So the yield on TIPS, the real yield, will be the nominal yield minus expected inflation and an inflation risk premium. At what yield to maturity do TIPS bonds typically trade? Well, on the 28th of March 2013, the bonds that were maturing in January 2023, around 10 years later, had a coupon of only 0.125% and a price of around $108. That implies a yield to maturity of negative 0.68%. In fact, as of March 2013, you had to look out to around 20 years maturity for TIPS before the TIPS yield to maturity, as quoted, is positive. The fact that there are negative yield quotes on TIPS has led some commentators to say that TIPS are bad investments because they have a negative yield. Well, there are a couple problems with that statement. First, remember the yield shown, and that negative 0.68% that I just mentioned, is not the yield you will ultimately get. You will get that yield plus realized inflation. So on that date, you could have chosen to either buy a 10-year nominal bond with a yield of 1.855%, or a TIPS bond for not minus 0.68%, but minus 0.68% plus realized inflation. So which is a better deal? Well, ex post, that will depend on whether inflation will be more than around 2.5% per year over the next 10 years. Second, the tips also provide insurance against inflation going up even more, and that insurance is valuable. Saying that tips are a bad investment because their yields are negative is like saying that fire insurance is a bad investment if your house doesn't burn down. Even more so because the insurance element of tips, the inflation indexation, is actually activated every month that there is inflation in the U.S. economy. Many academics have actually wondered why tips yields aren't even lower, given where nominal bond yields and surveyed inflation expectations are today. What happens if there is not inflation but deflation? Deflation is the opposite of inflation. We haven't had prolonged deflation in the U.S. here since the late 1920s and early 1930s. If you buy a regular nominal bond, so not a TIPS bond, and there's deflation, then your bond payments will actually buy you more than they do when you buy the bond. So deflation is good for owners of nominal bonds. What about for inflation-linked bonds? Well, that depends on the details, and U.S. TIPS have some important contractual features. The coupon payments would fall, but TIPS have a special feature that protects them against deflation to some extent, namely that at maturity, the purchaser is guaranteed not to get back less than the face value, the $1,000, in nominal dollars. One caveat is that the prices of the TIPS trading in markets today are quite far over $1,000. For this bond, it's $1,080, or $108 per $100 of face value. That means that if there's deflation, the face value of the TIPS bonds would actually have a pretty long way to fall, 8%, before they hit the floor. So the deflation protection is not as valuable when you have bonds that have large embedded capital gains. Let's have a look at the historical data on TIPS yields. The constant maturity TIPS yield is available from the Federal Reserve since 2003, even though these bonds have been around in the U.S. since 1997 in some individual issues. The lower line is the 10-year TIPS yield. Again, this is the real yield. And the upper line is just the regular nominal 10-year Treasury bond. The 10-year TIPS real yield has been negative since around late 2011. If we look at the spread between the nominal Treasury bond and the TIPS, we can see that with the exception of the financial crisis in late 2008, the spread has been around 2 to 2.5% for most of the time that the TIPS have been in existence. During the financial crisis, there was an extreme flight to the safety of nominal Treasury bonds, and perhaps fears of deflation that drove the spread down as far as 25 basis points, or only 0.25%. So to recap, inflation-indexed bonds are a useful security for investing in fixed income without the inflation risk. The way TIPS work is that whenever there is inflation, the face value and the coupon payments of the bond increase. The yield on a TIPS bond at any given time is a real yield, and that the buyer of the bond will get that yield plus realized inflation. The higher inflation turns out to be, the greater the benefit to the investor ex post. Now, you can't quite think of the difference between the nominal bond yield and the TIPS yield as the market-implied expected inflation. It's actually an upper bound on the market-implied expected inflation because there is also an inflation risk premium. TIPS are protected against deflation to some extent as well, but when there are lots of embedded capital gains, for example, because interest rates have fallen since the TIPS were issued, then this deflation protection won't kick in unless there were a prolonged period of deflation.